Hi everyone, welcome back to Be Rich. I have Sashwath with me finally. He's managed to pull some time out thanks to the holidays, which have come for him to record a video with me and have a conversation with you. He's got an interesting article he had read about and he wanted to share his opinions about that article. So without wasting further time, Shashwat, what is this article all about?
Yeah. So, first of all, happy to be back. Maybe by the time this video comes out, it's already Christmas. I wish you a Merry Christmas and a Happy New Year. And this video, I wanted to talk about this LiveMint article, which I had read. And usually I peruse through the newspapers to come across any sort of important headlines or any sort of information points that could help me with my investments, and not only my investments, but also content creation here. So one of the articles that caught my eye per se is Indian stock market lessons for investors from 2024 and risks ahead for 2025. So I had written a similar article with my other uncle for the Hindu about a year ago, which was talking about lessons for investors for the year ahead. That was something we had done as well. So it piqued my interest. This is around the time when a lot of your, let's say, newsstands start posting articles about what they can expect in the upcoming year. If you're reading something like The Economist, they talk about top 10 predictions for 2025. Or if you're reading, let's say, Wall Street Journal, they try to make predictions on US politics for 2025. When you're reading papers like LiveMint or Business Standard, they're trying to predict what the stock market may look like in 2025, the factors we may have to keep in mind. So this article is something related to that. So first of all, let's break down what the article says. I'll hear your thoughts on it, and maybe I can share my thoughts on it too, and we can discuss on it. So the article basically says that there are a few lessons one must learn from 2024, and it predicates these lessons on the idea that the Nifty 50 has delivered quite a decent return over the past year. It's delivered over 9% in terms of return, which is a pretty sizable return. And the broader market with the Nifty Mid Cap 100 and Nifty Small Cap 100, both of these have posted gains of over 25%. So it talks about these two numbers, and it also says that, however, given these numbers, the last quarter was not so good for the previous financial year. So when you look at the previous quarter at the end of this year, we saw that the Nifty corrected by 6.2%, and it corrected again by 0.3% in November and then 1.6% in December. So it's corrected quite a bit per month towards the end of the year. The article mentions FII selling, and it also mentions the pressures which the market is facing from around the globe in terms of conflicts. We already know the conflicts, maybe we don't have to cover them in detail here. So, given these points, the article then goes on to say that there are a few lessons one can pick up from 2024. One, patience, that after rallying in September, the article says that the domestic market experienced a pretty sharp downturn, which basically means that it's a roller coaster, and you have to stick in the roller coaster and wait for the turbulent times to pass. And then it also says that diversification is important. It says focus on fundamentals. It also says resilience, which is, I think, very similar to the previous point. It also talks about challenges and risks. It says that there's going to be high valuations, and that means that there might be intermittent corrections, apparently. And it says a buy on dip strategy is important, and you pick fundamentally robust stocks and you capitalize on corrections and build long term portfolios. It says it also says that there are going to be geopolitical and economic risks, but it also says positive developments could act as catalysts. And it says sectoral headwinds. It talks about IT because of Trump coming in and foreign policy and trade between the US and India. It talks about a downward pressure on IT and pharmaceutical companies. It also finally talks about other global factors, which namely being interest rates, economic performance of other countries, those kind of things. So this is the gist of the article. What do you think that the author has been on the money? What do you think about it? I want to hear your thoughts on it.
Well, I'm not a believer in buying in dips or just in corrections because if you're waiting for those kinds of dips and corrections, sometimes you can be waiting forever. And my general understanding of this whatever data I've studied so far in my, not in depth as much as you guys do, in my basic level of understanding of data, anything over 10-year period of time, these dips and all tend to straighten out. Even the pandemic dip, which happened, kind of levels off, and you just see the normal growth of 12 to 11% on an average on most stocks. I even did a video about this kind of an idea in Tamil and in English, where I just took 2009 as a date in a year because I do not know every individual's risk profile. I don't know their investment capacity. So I took the idea that, let's say, talk about myself. 2009, I could have, invested 2,000 rupees every market day. That's around 40,000 rupees a month because I had my father taking care of my boarding, my food, and I really didn't have any expenses per se. I didn't have any loans. I could have all the money which I was generating in my business at that point in time. I could have looked at investing at least easily 40,000 rupees a month into the stock market. And I just picked the big companies of India at that time, HDFC, Reliance, ICICI, Dr. Reddy, and these all various sectors, around 10 companies I picked. And I took the data points for a period of 15 years. So that's around 3,000 data points I took. And I decided every first of every month I buy, regardless of price or evaluations. I just buy these companies and I keep investing 40,000 rupees every month. And I do this for 15 years. Where will I be? The calculation led to me that if I'd done that from 2009, and 15 years would be now 2024, I would be sitting at 4 crores with an investment of 40,000 rupees every month going forward. And I would have compounded it at an average of at least 18%. So that led to me thinking, let's do this experiment for 5 years. And let's say I only invested in Tata companies where I don't look at PE ratios. The last 5 years, the same experiment I do. And there also, if I'd invested over there 1 lakh every month, I would be standing at somewhere around 1.7 crores. So this gave me this, clarified this idea of constantly looking at dips, that you should not be targeting dips. You should just be consistent. In any program you want to make, improvement, especially in compounding, compounding only works is if you're consistent. It really doesn't matter too much on valuations, and it matters to the point when you decide to enter. But what is more important is the quality of the company and the quality of the stock. And if you pick the quality stocks and you keep investing over a long period of time, you will tend to be making returns. The big thing, if you pick the right valuations, is your returns, instead of being 18%, you might have compounded at 20% or 21% or even more. Of course, the biggest caveat, which is also true, is we were in the middle of a huge bull run from 2006 to now. We're still in a bull market, except for those pandemic dips which happened, those anomalies. Everything else, if you look at it, we have been going through a bull run and we're still in the midst of a bull run. Though macroeconomically speaking, we have things to be concerned about and we should not be taking it for granted. But the market still is grip of a bull run. So I'm not a big believer in buying in dips. So my strategy this coming year would be, there are 247 days to invest, and try and be consistent in those 247 days. Thankfully, like dieting or meditation or journaling, you don't have to be consistent 365 days a year. You just need to focus on 247 days. And if you stay consistent in those 247 days, you might be able to be moving forward in your investment. That's my thought behind this. What do you think?
I agree with you. I think there are two elements to this. One element,
Mm.
like you mentioned, is consistency, and no matter how each individual, investment goes, that is how each individual entry point goes. It doesn't matter because in the long run, as long as you're consistently entering the market, albeit at different rates, it shouldn't matter in the long run. Which I agree, which is the concept behind dollar cost averaging. And if you consistently put in a certain sum of money, then mathematically speaking, it works out like a weighing scale where it works in your favor. So I agree with that. I would also add to one point which the article sort of glosses over, in my opinion, or maybe they didn't have the word count for it. So for the viewers at home, usually when you write an article like this, you're given maybe 700 words if you're lucky. So there's not much room you're working with over there. But to the credit of the article, it does try to touch upon a lot of the points. I think it does forget to mention that valuations are much more important than the tiny one sentence or one word it's given to that topic. I think that buying in dips doesn't necessarily mean that you still score a good bargain in terms of valuations. I think that if you're able to invest the same 40,000 rupees, like you said, or even 10,000 rupees, or even 1,000 rupees per month, but if you're able to invest it in bargain purchases, if you have the time to identify bargain purchases, if you don't, this point is moot. I think you should just index and put your money inside the Nifty 50 every month. However, for those of you who have time to pick and choose and be choosy on what you want to purchase, I think it makes sense to put the 1,000 rupees into a basket which is undervalued to the market, because like you said, the difference is maybe 4-5% maybe in terms of compounding annually. But I think that for those of you who have the time, the skill for the craft, and the attention to detail which it requires, and let's say even the cognitive or psychological makeup required for it, I think for those of you who want to do that, a 5% addition on top of the average compounding rate is a pretty solid outcome to hope for. And I think that it's something which compounds at a huge rate over the long run. Like if you compound at 18% for, let's say, 40 years versus 25% for 40 years, at the end of the 40 years, it's a dramatic gap. But like you said, after a certain threshold, it doesn't matter how much money you have. It's more about the joy of investing and compounding at that point. But for those of you who enjoy this activity and have the time and attention for it, I think it may make sense to focus on value a lot more than what the article professes. Because, like we know with Asian Paints and other companies, not every point of entry is a great point of entry. Not every price is a wonderful price for a quality asset.
True. And situations and circumstances change for companies. So it's important to keep an eye on it. Like what is happening with Asian Paints is a correct example. 10 years ago, its situation and its market conditions were very different from the next 10 years for Asian Paints. Next 10 years for Asian Paints is going to be very difficult and very trying because competition is increasing and the situation is also changing. The dynamics are moving. So you have to always keep an eye on it. You just can't keep buying a stock and saying it's going to be good forever. Even in the case of Tata's, a Tata company, just because the name of Tata, you just can't keep buying it and closing your eyes and forgetting about it. You do have to keep abreast with the news of what is happening pertaining to that specific company and that specific sector. And you should not, be blind to it. Is very right and very true.
And finally, last point, I think what you said makes sense, and I think it's a good way to view investing because, like you said, be it meditation, journaling, exercise, whatever it is, doesn't matter. How you perform once you show up. I think it matters that you do show up, and
True.
I think it's a wonderful strategy for those of you who haven't been so consistent in 2024. I think this is a new chance, another chance at being consistent with the New Year's and New Year's resolutions. I think maybe investing consistently should be one of the resolutions. What do you think? Can it be something like that?
Yes, and I'm actually opening up a challenge, which
Okay.
if you guys are following me on Instagram in the 52-week challenge group, is the idea that I'm going to show up for the next 247 days next year, all the market days when the market is functioning, and the whole idea being is that we stay in different coffee ranges the whole entire time. I'm going to be encouraging everyone to invest as I invest for the 247 trading days in the next year. And the whole point of that is those 247 days, I'm going to stay in different coffee ranges. Even if I see anything dramatic and drastic in the market, I will continue staying in different coffee ranges. And to show that kind of consistency by end of the year, if I'm going to be putting around 2,000 rupees every day in the market, I would almost accumulate around putting 5 lakhs into the market and to show how we're going to build this. So the idea is this is a long-term project. You see on YouTube, you see, 1 year challenge, 6-month challenge. This is going to be like a 10-year challenge. Me and Sashwath and Anand are going to be around for some time. So the idea is that, first, this is the first one. Like that, I'm going to build 10 years. We have been in YouTube doing this for 5 years. So if I had managed to think of this idea 5 years ago and started, we'd be halfway through the journey. Unfortunately, at that time, it didn't strike me to do this. But since it's striking me now, I thought we'll do this. We'll go for the first year. And I encourage everyone, all our viewers and people in our group to participate. And I'm going to be showing what I'm doing I don't want you to share or show whatever you're doing. That is your personal thing. This is just something to encourage you guys to get down to doing it. That's about it. And to show that should being consistent. It doesn't have to be dramatic amounts, just staying in tiffin coffee ranges, but being consistent for 247 days is going to show you immense returns compared to not doing anything at all or trying to buy dips or getting paralyzed with, looking at PE too much and valuations too much. Yes, we have to look at those things. It's important. But most important is finally when you reach the gym to do some workout. You may not be able to work out the dream workout which you wanted to do. You may not be in the physical shape to lift, deadlift. You may not have reached a physical shape to do a pull up, but that doesn't mean you don't do anything at all. You aspire to do a pull up. That same way in investing, you aspire to do valuations by yourself. You aspire to find that cigar butt on the floor, as Ben Graham would say, or aspire to find the right price for the company, as Charlie Munger says. But till that point of time, we keep moving and we keep putting some punches out there. It's the idea behind this. So, what do you think, Shashwat, about this?
I agree, and I think the point earlier that I mentioned regarding the 18% and 25% only applies to those people who are already in the gym and like look like Arnold Schwarzenegger. If you're
Correct.
looking like me or you, and someone who barely enters the gym, then going from sitting down to standing up itself can be like a huge change. So in
Correct.
that regard, I think showing up is like winning half the battle already. So I
True.
agree with you, and I think it's a great it's something which I hope a lot of people do join in, and I hope to carry it forward with you in the
Yeah.
upcoming years.
Yeah, and this challenge has no cost to join in. There's no special software you have to use. You don't have to use any platform. You do it in your pace, with your preferences, in your situation. And in a few videos coming up before the first, I'll try and outline it. If Shashwat has some free time, I'll pull him in and we'll outline it together. Otherwise, I'll outline it. And 1st of January is a market day. The market is open on 1st Jan. So we'll start on 1st Jan. Anything more you want to add, Shashwat?
No, I think this has been a fruitful discussion as it is.
Okay. Thanks for watching the video, guys, and I hope you enjoyed it. We do wish you a wonderful New Year as it's coming ahead of you. I hope you had a wonderful Christmas. Few more days of holiday, then the New Year is upon us, and we get to work. That said, do like and share and comment, and do share it with people who will find this video inspiring or would find it fruitful. That would be helpful to us and them. Nothing more is to say. Thank you for watching Be Rich today. Bye.
Thank you. Hey guys, that my uncles Vinod Srinivasan, Anand Srinivasan, and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it, and we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for the Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you.